Hi everyone, I welcome you again to my YouTube channel Tech Advance. Today we are discussing another important topic, which is the majority of early stage VC deals fall apart in due diligence. So before discussing this important topic, I request you kindly to subscribe my YouTube channel Tech Advance and also press the bell icon to get notification of every video I uploaded as soon as possible. And get benefited from it and watch the video completely. So we're going to start our topic. Here's the majority of early stage VC deals fall apart in due diligence. Here's what investors are looking for when writing the first check into a fledgling startup. Owning Five Flutes fundraising and tearing down the deck the company used to raise its $1.2 million seed round had me wondering, how the hell do investors decide whether to invest in a company at the earliest stages? VC firms Baukunst led the Five Flute investment, and I sat down with Axel, Bichara, and Tyler Mincey to learn how they evaluate a potential early stage deal. They told me that the vast majority of the deals they look at fall apart at the due intelligence stage and helped me get a deeper understanding of what that process looked like from the inside. Common wisdom tends to generate mediocrity that's not helpful in VC. We are looking for the outliers. Axel Bichara, co-founder and general partner, Baukunst. The decision to take a second meeting is one of the biggest decisions in venture capital because from that moment onward you are committing significant time. Bichara said, explaining that in his experience they only invest in 1 out of every 250 deals or so, that they see only about 1 to 40 first meeting result in second meeting. Everything you do after the first meeting I consider due to diligence. You are evaluating the founders at the stage we invest. Most of our due diligence focuses on two things: the quality of the funding team and the size, attractiveness of the market opportunity. If you get those two right, everything else will fall into place almost by definition. With the right team and a huge market, everything else can be figured out later, Bichara argued, saying that if you have a great founder market fit, you are off to the races. The right funding team will do the right thing. They will execute well, and there will be capital efficient market opportunities. You enter with a competitive advantage. Find a niche and scale from there. If you don't get a resounding yes from those two, you shouldn't invest. Bichara explained. All the due diligence you do is geared toward answering those two questions. In the case of Baukunst, the firm's investment thesis means that for an investment to make sense, the startup need to at least have the possibility of $1 billion outcome or more, which means that the market opportunity needs to be big enough to enable that. If the funding team executes well, you just work backward from here, Chara said, and all the due diligence we are facing. So that's our important video. Hope you have like it. If you like it, kindly share it with your friends and family. We'll meet on the next video. Thanks for watching.